and welcome to the webinar on protecting your retirement savings. I'm Jagdish Agarwal, former Dean of the College of Business and Economics at Cal State East Bay. Currently, I'm managing the college's Center of Financial Literacy. We are going through a very difficult time due to coronavirus. We're all very sad that we have lost more than 60,000 people in our country due to this virus. 30 million people are seeking unemployment benefits. Unemployment rate is expected to reach 16% very soon. Many people have lost their businesses. Many of us are very worried about our savings in retirement plans and value of our homes. We have received a lot of questions from you regarding investment and real estate market. Thank you for sending those questions. We hope to address some of your concerns and talk about the best practices of investment and real estate markets by engaging in question and answer with our distinguished faculty of finance at the College of Business and Economics at Cal State University. Joining us today are panelists, Dr. Tammy Mosley, Professor of Finance and Real Estate, Dr. Scott Fong, Acosta Professor of Finance, today. What happened here? Dr. Scott Fong.
Hi, Travis. I think you need to start my video.
Acosta Professor of Finance. Dr. Eric Trickey, Professor of Finance and Associate Dean. Dr. Sinan Goktan, Acosta Professor of Finance. I will be asking a set of questions to one panel member at a time. Other panel members may participate in answering those questions as well. If necessary, I will ask follow-up questions. Please remember that answers given by our panel members are their expert opinions. They are general guidelines and best practices, but not personal advice regarding your financial concerns. Let's get going. My first set of questions are for Dr. Tammy Mosley. Dr. Mosley, although the financial market is in turmoil, the real estate market seems to be relatively stable so far. Given the current circumstances, what do you think will happen to home prices in California? What do you suggest to those who are considering to buy a house or sell their property or refinance their mortgages, especially in view of decreasing interest rates?
In view of what?
Dr. Mosley?
Thank you, Dr. Agarwal. I have a few slides that I would like to share today with the attendees in responding to these questions. The PowerPoint slide available?
Nope.
Travis?
Travis, is the PowerPoint slide available? Dr. Agarwal, can you see the PowerPoint slides?
No.
Okay.
Practice your presentation.
Well, I'll just proceed in discussing the information that we have here. And what you have to be able to think about is that as of this week, we want to understand the environment as a whole with California. And for this week, because of the stay-at-home orders, there has been a significant change for the real estate industry, and that is in regards to commercial as well as residential real estate transactions. They're actually allowed to fully resume. However, it is with continued restrictions on in-person viewing and appointments. Also, all construction projects can resume provided they comply with safety protocol. So these are very significant adjustments to the stay-at-home order in regards to how it will help the real estate market. But what we have to also keep in mind is that employment job claims are now at 30 million since the middle of last month. And something that's very significant in considering the affordability of housing is being able to look at stability of employment. Something that we tend to look at are trends when you want to think about house prices, not just in California, but in the nation as well. One of our house price indices that we use is Case and Shiller, and they give us an overall outlook on how prices tend to increase or decrease in different metropolitan areas. For our area in particular in California, we have the San Francisco Bay Area Price Index from Case and Shiller, where it covers overall 5 counties in our area. And I will show you later these 5 counties, and I'll highlight them for you, well, at least with the discussion. And so something that we have to keep in mind as well is that this index shows us that prices have increased steadily from 2010 until March 2020. However, with our stay-at-home orders, these prices and for housing in our Bay Area, they have had a decline. Overall, we've had a decline of about 21% in home sales, and that's reflective on our prices as well. And in our prices, in the entire state of California, house values have gone down. And when we speak of values in the state of California, we typically look at median house values. And because median house values, it helps us to take out any type of outliers that may be there for house prices. So within a 1-year period, March 2019 to March 2020, these house values have actually gone down. Something else that we have seen is when we want to take into consideration, is it a good time to buy now, or is it a good time to sell real estate? That's very popular when we're thinking about the real estate as a whole. Most of us, for our portfolios in our entire lifetime, what will have the most value is our real estate portfolio. And for our real estate portfolio, that's pretty significant, even when you're relating it to your stocks and bonds that you have. And so for real estate, when you make those decisions, it's very critical to be able to have as much information as you can and do as much research so that you can make a well-informed decision when you're trying to look at what to put into your portfolio or what to take out of your portfolio when you're thinking of your home as a part of that portfolio. So when you make these decisions, well, it depends on demand, it depends on affordability, as well as buyers' financial capacity, hence job security. And what I opened with earlier was that our unemployment now is significantly high in our nation. And again, we've had unemployment claims of 30 million. So job security is something that's very important to us as buyers. And who else is taking this into consideration as well are the lenders, because the lenders, they want to make sure that buyers have good stability with employment when they originate loans. Another significant aspect is being able to take into consideration interest rates. When you take into consideration interest rates, it's not just interest rates are low, whereas now they're at historical lows. According to Freddie Mac, interest rates are as low as 3.29% for a 30-year fixed rate mortgage. So it's good that interest rates are low, but again, we need to have job security. We also have to take into consideration any type of savings that we have, and do we want to use those savings now to be able to purchase property, or do we want to keep our savings longer in the aspect of not being sure what the future outlook of our economy is, especially with COVID-19. So when you're taking into consideration if you're going to be able to qualify for a loan, well, there are certain loan limits that are put in place. And these loan limits that are put in place by the federal government, we have something called FHA, and that's our Federal Housing Administration. Those loan limits, they are about $300,000 to as high as $765,500. And so that's in particular for counties that are very expensive in regards to housing values. It's not just the state that, for instance, California is considered to have high housing values. However, it's looked at by county. So for counties for California, that's included in the Case and Schiller Index for San Francisco Bay Area, we have Alameda County, that has the high loan limit of $765,000, and actually it's $600,000, not $500,000. Excuse me, $600. So $765,600. That's the loan limit for Alameda County, Contra Costa County, Marin County, San Francisco County, as well as San Mateo County, and other counties as well within the Bay Area. But you have some counties such as Fresno County, their loan limit is around $300,000, but that's also indicative of how low their house values are relative to that of the San Francisco Bay Area. We've also had a pending sales decline, and that's declined sharply since our stay-at-home order. It's declined at over 20% when you go even from January to March of this year. Another aspect that prospective buyers may have concern about is taking into consideration if they do want to pursue purchasing a property at this time, well, should they use their retirement savings that's in an IRA account or a 401k? Now, the one that is the most beneficial is the Roth IRA, because you can pull money out of the Roth IRA. You can pull earnings out, actually. You can withdraw up to $10,000 in earnings if you held your Roth IRA for at least 5 years. However, you can withdraw any contributions at any time without a penalty. A traditional IRA, you can also withdraw up to $10,000 for purchase or repair or remodeling of your home without paying a penalty. But you will have to be able to look at the impact of your income tax on the entire amount. So that's another choice that one can make. Now, when it comes to your 401k, the best thing to do is to borrow against your 401k, because if you just pull the money out of your 401k for a down payment for real estate, you can be assessed a penalty of 10% on that amount. So the best strategy is to borrow against your 401k if you have that. But what some savvy investors will do is actually they'll roll their 401k into an IRA. And you should definitely talk to your tax accountant for the process and how you actually accomplish that goal. So overall, you do have to take into consideration your resources that you have, as well as taking into consideration your outlook into the your employment outlook, and as well as house values, so you can make a well-informed decision the best that you possibly can in the state of the economy that we have right now.
Thank you, Dr. Mosley. Next, I'll go to Dr. Scott Fong. The stock market has already gone down significantly. I have already lost a significant portion of my retirement. I'm very worried that I might lose more. What should I do? Are there specific industries that I should focus on when investing? Should I sell my mutual funds or stocks to avoid further loss of my retirement savings? Or maybe do nothing, because I have heard that stock market always comes back. It is just a question of time. Is it true? Dr. Fong?
All right, thank you, Dr. Agarwal. Thank you for your questions. So let me share the screen. So again, it's good to see everyone here today. So my part is about answering Dr. Agarwal's question earlier. And my point of view is to provide the attendee an overview about the stock market, and especially back to what Professor Mosley said earlier, try to provide everyone a platform for informed decisions. And at the same time, I also want to share with everyone some data, some big pictures about some view about the stock market. So let's get started with the big picture first, shall we? Okay, so this is the big picture that we've seen so far in the stock market. And there are two color lines you see in front of you. The green is actually representing the S&P, and this is actually ETF based on S&P, the SPY. And you can see here, this is showing you the data from 2004 up to yesterday, April 30th, 2020. All right. So you can see there are two big episodes going on here. The first episode is our previous global financial crisis in 2007 and 2009. And you can also see the happening of the recent crisis. The lowest point that we have seen so far is on the S&P is 222.95. So that is actually on March 23rd. All right. And now on the second part, of the graph here, you see a red line. The red line is actually something I want to discuss with the audience here. This is actually what we call the CBOE volatility index. All right. So that this is an index represent the volatility of the stock market. Okay. So as you see here, the first way we can see here is volatility is not a constant. Volatility is quite volatile, right? And the CBOE index is also known as the fear factor. So in other words, whenever you see this fear factor jumps, that's also about the time you see the market, bearish market or a market crash. All right. So the most significant, observation we've seen so far is this implied volatility index, or the CBOE, fear factor, has reached the historical high of 82.69. All right. On March 16, 2020, all right? Historical average is about 20. So as you can see, if you look at the trend lines of the two time series, you see uptrends, right? Long-term uptrends for the S&P. And if you look at the volatility index, you see, right, we call the mean reverting. So basically, you see jumps, right, when there's a bearish market, but sometimes, they revert back to the level. The average is about 20, right? So as you see here, we see two big jumps historically. These jumps actually happening in the previous 2007 and 2009 financial crisis. That jump's happening around the month when Lehman Brothers filing bankruptcy. And now you see another jumps, all right? So the jumps that we've seen in the recent crisis, this is actually the historical record high on March 16, all right? So in other words, I want to give everyone an overview first, right? Based on the data we've seen so far. And now let me dive into the comparison, all right? So on the next page, I'm going to show everyone a brief overview about the comparison between two scenarios. All right. On the first case, this is our previous 2007, 2009 global financial crisis. So this is actually the information I presented with our CSU East Bay alum and students almost 10 years ago. And on the right, you actually see the recent corona pandemic, right? So in terms of the nature of the risk, one thing we can also keep in mind is the source of the risk, the characteristic of the risk is a little bit different between our current crisis and the previous global financial crisis. In our previous global financial crisis, the shocks was originated from the financial market and kind of spill over to the economy, the global economy, and so on. But this time, the shocks was originated exogenous. So we call this exogenous shocks, which affect both the financial markets and the real economy, right? So now let's look at some important figures. So I did a simulations, a couple of days ago using the real data, and the simulation I use is based on a buy and hold strategy. So basically, what it means is, as an investor, you make investment onto the stock market, you hold on to it for a holding period of time, and you want to see, what kind of losses or gains you make, right? So if we do a buy and hold strategies during the financial crisis, the previous 2007, 2009 crisis, the largest one-day loss you make could make is about a negative 10%. All right. And on the other hand, if you do a buy and hold strategies, for example, in the beginning of January 2019, buy and hold until April 30th, yesterday 2020, one of the largest losses you can see on a single day loss would be about a negative 11%. All right. So that's the one-day largest loss you will experience. But on the other hand, since I mentioned earlier, this is a buy and hold strategy. That means, you hold on to the portfolio, right? You buy and hold the strategy, and you want to see what we call a, cumulative gain or losses, all right? So if we do a buy and hold strategies, in the previous crisis, the largest cumulative losses you lost is about a negative 13%. And you can also see if you are doing the same strategy during the recent months or years, during this crisis, the cumulative losses is also about the same, negative 14%. All right. So this is actually about this simulation I mentioned earlier, based on the real data using a buy and hold strategy. Another thing I also want to highlight is if you look at the stock market volume, which is usually used as a proxy for the liquidity of the market, one of the largest drop you see for the previous crisis about a negative 72% drops in the trading volumes in the previous crisis. And very similar, you see during the recent pandemic crisis, you also see a large drop, a one-day drop. The largest single-day drop we've seen is about a negative 64%, all right? And finally, of course, as I mentioned earlier, if we look at the fear factor, which represent the investor sentiment of fear, the highest VIX we've seen, or the value of the implied volatility index we've seen from the previous crisis, is about 80.86. And this time around, we also see the historical high of 82.69. All right. So we also see in both crises, we see significant increase in both the fear factor and also significant drops in the market volume. Now, however, this is not the end of this picture. What I want to show you next is I also want to show everyone a different view, right? A different perspective about the market. All right. Now, what I show you right now, the red color is telling you, the short term, the one-day drop or one-day changes. But what about the longer term, right? What about the longer effects? Okay, so if we look at a buy and hold returns, right, on a longer term basis, so let's say you make your investment back in January 2007, you exit in December 2009, your overall return is actually a minus 1%. And similarly, if you actually make an investment back in January 2019 and you sell out tomorrow, yesterday, your overall cumulative returns is actually zero. Okay, so try to understand the difference between a single one-day changes in the prices and versus a long-term cumulative changes in your returns. All right, and similarly, if you look at the volume, right, even though we said in the crisis we see a single-day drop in volume, but the overall volumes is actually a positive 5% during the previous crisis, and a overall, you can see, right, exactly similar to magnitude, a plus 5%, for the recent during the recent crisis, and finally, of course, if you go back to the previous picture I showed you earlier, the implied volatility index jumps, right? But they usually come back, right, and mean reverting. So that's why you see the average VIX, right, the volatility index during the crisis is about 27 last time, and it's about 20, about the long-term mean. All right. So the point I want to set here is, try to understand the dynamics of the stock market and try to understand or differentiate the perspective between short-term and long-term. All right. Because that's why I want to show you, different layering of the picture here. But at the same time, so far I just show everyone, about the pictures, the data we can see from the financial market. What about the real economy, right? Okay. So if we take a quick look at the real economy, the first indicator, usually we see is the test spread. Usually is an indicator for credit risk. So during the previous crisis, we do see a fairly high test spread, a 4.5%, in the previous global crisis. And in the current crisis, so far, when we collect the data until the end of March, it's about 1.42%. Unemployment rate, last crisis, about 9.3%. As of March 2019, it's about 4.4%. And real GDP growth was a minus 12.5% in 2009. And in 2019, is a positive 2.3%. Now, the main issue is the following, right? The main issue is right now we're in the first day of March, and most of these macroeconomic indicators are not necessarily reviewed. So that's why I think one of the biggest concern is the uncertainties, right? What happened next? So if you look at the data now, these are the historical data. These are not necessarily the most recent data. So this is one of the concerns about the uncertainties from the real economy. And now the next step is to respond to what Professor Agro asked me earlier. What kind of industry, right? And whether we should focus or we should diversify or not. So, and remember, right, the shocks is coming from the pandemic, the implications coming from the social distancing. So one of the takeaway is try to understand, there are different industry, they have their different sensitivities and resiliencies to pandemic and social distancing, right? So on the one hand, we can relate this to our daily example. We can see that, for example, manufacturing company, airline services, restaurant, tourism, they were impacted by the pandemic and social distancing. And at the same time, right, we also see, communication, e-commerce, grocery, health, they're also affected differently. Now, this is the impacts we can see for the short term. But what I want to highlight is one thing we don't necessarily see is the long-term impact, and also what I call the structural impact. What I mean by structural impact is the following. Because if you look at the industry, right, they're basically part of the players of the supply chains, right? They're not independent industry. So I think what we need to understand is we should have a broader view about the systematic wide impacts on the supply chain on different industry. And I think we should take a look or be aware there will be spillover. So it's really hard to say, communication, were affected differently and they're resilient, but at the same time, industry are part of the players, right, of the whole supply chain. And another point I want to make is also pay attention to global economies, right? Because especially many of these industries are global companies, right? So that's why global economies is another important perspective we should understand. And of course, as I said earlier, try to understand the short-term impact we can observe, but also understand the importance of the long-term impacts, which is actually, driving the uncertainties. And finally, again, back to the question what Professor Agro asked us earlier, should we sell now, and buy later? Of course, I'm not the advisor, but what I can do is to offer you the pros and cons, and you can, make your best, most informed decisions. If you sell now and buy later, basically, I mean, the advantage is you can stop the losses, realize the losses, you can cash out, and of course, there are other implications like taxes, etc. But the concern is, of course, when you want to buy it back, you have to think about your investment, you have to think about your opportunity cost, transaction costs, and you might have to deal with regret too, right? Because you don't know, when the market's coming back and so on. Another strategy is, let's say, hey, do nothing, right? Just hold on to it. Okay. If you do nothing, well, your portfolio is alive and there's no need to think about reinvestment. But on the other hand, the concern is, of course, you might have to think about further losses. There will be increasing risks and uncertainties. And of course, instead of dealing with regrets, now you have to deal with fears, okay? Of course, finance instrument is more than just buy, hold, or sell. I mean, there are also other instruments, investor can consider. For example, you can consider a market neutral or hedging or some sort of insurance using ETFs, derivatives, etc. But again, the concern is, of course, there could be hedging costs. Hedging will not be free. You have to pay a premium. And also the other concern is if you're using, derivatives or ETF, as an add-on to create a market neutral strategy, it will add some complexity, to your investment. At the same time, there will be operational risk. Finally, the last question from Professor Agarwal, maybe just do nothing, right, and let the market recover and let time, help us, right, on the portfolio. Is it true? Well, these arguments usually based on the notion of time diversification, And time diversification actually means what? Means on average, your bad returns will be offset by your good returns over time. And market seems to be fine in the long run. But be careful, time diversification has a hidden assumption. One of the strong assumptions is it assumes that returns are independent over time. And it also assumes that volatility will diminish over time. However, let's look at the reality. The reality is, as I showed you earlier, volatility is actually volatile, okay? Volatility does not necessarily decrease over time. It might actually increase with time. And secondly, if you're thinking about, using time diversification on a single stock industry, that might not work because again, you still need to look at a well-balanced portfolio and you make sure that, especially as I showed you earlier, there are uncertainties about the macroeconomic changes, the overall environments, the interdependency. So maintaining well-informed decision and flexibility, liquidity is actually important. These are some strategies to deal with uncertainties. And to wrap things up again, here I try to provide everyone, understanding of the data, a understanding of the picture, and most importantly, try to understand the difference between short-term and long-term perspective. So that's why I will conclude here with the same picture here. You can see here, when you look at short-term and long-term, you would likely gain a very different perspective. All right, so I think that will be it. Okay.
Dr. Agarwal, sorry to interrupt you, but I'd just like to remind.
Looks like I'm going to hang on to my investment and not think about selling now. Next, I'm going to go to Dr. Eric Fricke. I have been saving money for retirement by investing in stocks, bonds, and some of the other things. Should I continue investing through my retirement savings plan? Or continue saving but invest in bonds instead of stocks? Or should I stop for the time being, putting more money in my retirement saving plans until the market improves? What should I do?
Thank you, Jagdish. I don't know if Travis had a question. I kind of heard him say something.
Yes, I did. Thank you, Dr. Fricke. I'd just like to give a reminder to everybody to please submit your questions via the Q&A tab. There are quite a few questions that are being asked in the chat, and it's kind of gets hard to keep up with them. So the best way of keeping it organized is to submit them via the Q&A tab by your Zoom controls. Thank you.
Thank you. So I'm going to address the two points that Jagdish brought up. One is about the viability of continuing to invest through your employer's retirement plan from an academic perspective, and the other one is to look at the choice between stocks and bonds. And again, I'm going to do that from an academic perspective, and not necessarily I'm not acting as your paid financial advisor. So please take that into account. So if you're going to invest through your employer's retirement plan, there are definitely some advantages to that that'll help you long-term from the standpoint of not using your employer's retirement plan. Many employers, not all, but many employers have some type of matching program that might match 50, 25, 75% of your own contributions. And if your employer has something like that, that's very definitely a good thing to take care of. And I wouldn't stop doing that during this time period, especially if you're getting some type of matching contribution from your employer, because it's probably likely that matching contribution would take care of any type of potential future losses. There are other advantages as well. In the employer's retirement plan, you have the option of pre-tax or after-tax in investing, and depending on which one works for you and the tax rates that you're in, you can take advantage of those. I'm not going to analyze that situation for your particular case, but having that relatively simple option within your employee's retirement plan is also a nice benefit. And then when you take advantage of an employer's retirement plan, you're saving on a consistent amount of money every paycheck and putting it directly into an investment. And that leads to something called dollar cost averaging, meaning that over the long term, the price that you pay is a weighted average of every period's share price based on the number of shares that you purchase. So an easier way to call that is like you're paying an average over a long time period. And the high prices that you may pay some months are going to be balanced out by the low prices that you pay other months. And so the advantage of this, especially with private investors, is that if you try to do something on your own, you try to time the market, chances are you're going to do worse. And that's what studies have found, that dollar cost averaging, taking the average, seems to do better than most investors, because most investors, if they take the decision process away from that automatic investment process and they try to sit and time the market, they tend to do worse than the average, which is kind of surprising, because it's not just an average. You know, the distribution of how investors do is slightly skewed toward the negative of the average because of these decisions that they have to make. So why do they do worse? Well, think about it. If you decide not to invest the money, then you're going to be sitting on uninvested money waiting for a lower price. And if that doesn't happen, you're going to start to get anxious. You're going to start seeing prices go up. You might wait, well, maybe the price will go down, maybe it won't, but then eventually you're going to jump in, and chances are the price has already gone up quite a bit by then. So it's that decision process of knowing when to jump back in that a lot of investors have a problem with, in terms of whether or not they should stop contributing money to those retirement accounts. And in the meantime, while you've been waiting, you've lost time in terms of getting interest or dividends on the investments. You've lost time in terms of compounded returns over the long run. So from looking at individual retirement plans, his history says that you're better off just sticking with dollar cost averaging, as opposed to timing the market and going in and out, hoping that you're going to be able to be rational and not fearful, and wait until prices are already up high before you go back into the market, because that's what fear drives people to do. They're just going to sit and wait. Another advantage of the retirement plan is the money comes out of your paycheck before you have a chance to see and spend it. And many people have a problem with spending, right? So if the money comes into your pocket and you see it, you might start thinking about that other car, something else, some other type of consumption you want to have. It makes it harder to do that steady investment plan. So having that employer retirement plan that's kind of set it and forget it kind of can help you keep on your budget in terms of what your plans are, because you won't see the money. It's kind of out of mind, and you can let it sit there and compound over time and take advantage of the market's long-term performance, as opposed to kind of falling victim to the short-term ups and downs. So those are the key advantages, I think, of the retirement plans. And it's hard to see a downside, so that's that in a nutshell. The other question we got was about switching between stocks and bonds. And now theoretically, if you're an expert and you can time the market, when to go from stocks, when to go from bonds, theoretically you could do pretty well. But here again, just like when to stop putting money into your retirement account and when to put money back in, there's a decision process in there that can make it a very difficult decision to do. So think about, like, from a dollar cost averaging standpoint, we find that most individual investors are better by taking the average return from a steady mix of bonds and stocks over the long term than trying to switch back and forth in and out of stocks, in and out of bonds. It's that average performance actually does better than most people, which I know sounds kind of strange, but that's what we find with individual investors. If you're able to do the market average, you're going to do better than most individual investors. And part of that is suboptimal timing of when to go back into the market because of fear. Part of that is transaction costs. I'm going to give you an example. I was looking at the 10-year Treasury notes this morning. And I don't know if anybody knows the yield the interest rate that you'll get if you were to buy a 10-year bond from the government right now? I'll give you a hint. It's around 0.6% per year for 10 years. So basically what this says is the time to switch to bonds has already passed. That was about 6 months ago is when you should have switched to bonds. So switching to bonds right now, when the return you're going to get is 0.6% for the next 10 years, I don't know about you, but I'd rather bet on the market in 10 years, getting more than 0.6 return on average over the next 10 years. So, but that's me, and that's just looking at historical data. But just to make another point on that, the Federal Reserve Bank also sells bonds that investors can buy that are protected from inflation, right? And those are called TIPS, Treasury Inflation Protected Securities. And the yield on those is negative right now, right? And it's around a negative 0.3%. And that difference between negative 0.3 of the TIPS and the 0.6% on the 10-year notes is roughly what the market expects inflation to be. So the market is expecting about 1% per year inflation on average over the next 10 years. I imagine in 5 years, inflation will be higher than that, but right now it's going to be very low to, deflation almost right now. So, and companies, especially very high quality companies, typically have the ability to price inflation into their products, right? So if we all of a sudden get 2, 3, 4% inflation, high quality companies can usually raise their prices by 2, 3, 4, 5%. But if you invest in a bond, like say that 10-year bond of 0.6% return every year for the next 10 years, it's not like they're going to raise that interest rate for you. So in effect, if we get high inflation over the next 10 years and you're invested in a bond with a 0.6% per year return, you're basically flat to losing money every year in terms of real purchasing power. So thinking long-term where the stock market's going to go in the next 10 years, I don't know. I think a 10-year investment in bonds that pay 0.6% per year, I don't know. That doesn't look too good to me. And the other point to make about the mix between bonds and stocks in your portfolio, typically when you think about that mix, a lot of times that's based on your investment horizon and your risk appetite. And we're not typically thinking about constantly switching that mix to kind of opportunistically time the market, just because, the success of individual investors being able to do that really isn't there in the academic literature. So maybe you should look more at your personal financial plan, look at your time horizon to when you want to retire or whether or not you're in retirement, and kind of base that stock bond mix based on that, as opposed to trying to time the market, if you will. And I think that's all I have, Jagdish.
Thank you, Dr. Friki, for your insight. Now I'm going to go to Dr. Sinan Goktan.
Mm-hmm.
Unfortunately, some of our alumni may have already lost their jobs. Some of them may have closed down their business. They may need money to survive until their situation gets better. What should they do? Should they tap into their retirement savings? Or should they take a loan against their retirement savings instead of withdrawing money from their retirement savings? Or should they take equity loan or line of credit from equity loan or line of credit? Or should they take a personal loan given the current interest is so low?
Thank you, Jagdish. I'm going to get to your questions in a minute. So my section is mostly about how someone can steer through these difficult times in terms of managing their finances. But I know that most of the panelists are usually worried about the current situation and about what to do with their portfolio. So let me just give you an overview of what I think about that section of this discussion. So the number one lesson in finance is risk and return, right? We know that the number one principle in finance is the higher the risk you take, the greater the return you should expect, right? So, and usually it's people understand this concept, but when it's time to apply this, that's when people are having a difficult time putting it into actual use. So first of all, the first thing that we should all agree to is that no one has the crystal ball. So most of the questions are about, what do you think is going to be, how will the market look in 6 months? How is it going to be in 9 months, 1 year? The simple answer is no one knows. Go to Yahoo Finance, look at all the experts that are in this field. You're going to find people saying, this is going to be, we're going to get back to a better situation by the end of the year. And then you're going to see another expert, same qualifications, say this is going to take 3-4 years. This is going to be one of the worst downturns that we've seen in history, which automatically shows you that truly no one knows, right? See, assuming that these are experts in the field saying two different things, first of all, tells you that no one has a crystal ball to tell you this is what's going to happen at this moment. So every discussion we should have should start with this assumption. No one knows what's going to happen. The next thing is we know that it's about risk and return, right? So Warren Buffett actually tells you how he makes money. I mean, it's not a secret. He says, I'm buying when everyone is panicking, and I'm selling when everyone feels confident, right? Well, when you hear this, it makes perfect sense. But when you think about the application of it, it's not that easy, right? That's where this thing falls apart, because saying it is one thing, doing it is another thing. And the reason is the opportunities to buy any asset is when people are in panic mode, right? Going back to Scott's graph that he showed, S&P went down to 2,200. Well, was that a good time to buy? Now, after the fact, you can say, yes, it was. I wish I could have bought at that time, right? So that was a moment of panic. That's the moment that everyone was selling. Well, if you're the type, and of course, it's easier, this is easy to say versus doing, but if you want to make good returns in this market, that is the time to buy, not sell, okay? The time to sell was when you thought that the market valuations were high, which was pre-crisis moment, right? So why am I telling you this? I'm not telling you this because I'm telling you what to do, because no one knows. Maybe we're going to go back to that level. Maybe we're going to go lower than that level. But what the truth is this, those moments when everyone is in panic mode, if you buy at that time, it's better than everything else. So forget about selling. Finance theory says that if you want to make a return on this market, that's the time to buy, not to sell, okay? So going back to the questions of, well, shall we now switch back to bonds by selling our stocks? Well, we're at the moment where if you want to make money in this market, where you should be buying, well, forget about buying. If you're scared about the future prospects, which you might be, you definitely shouldn't be leaving stocks at the very least. Because if we look at the long-term trend, even though we don't know when things are going to turn around, we know that in the long run, things turn around. It might take 2 years, it might take 3 years, it might take 5 years. So that takes us to the next point that we need to consider when you choose your investment strategy. That is, how old are you, right? So if you're in your early in your career, if you're in your 20s, 30s, this is the time to take risk, okay? Why? Because if in the long run, things go back to the average, which is, if you look at the long run trend of the markets, it's an upward sloping curve, right? That means if you have enough long time period towards retirement, you should be in the market, not out. So it's not a time to leave, it's a time to be in the market. And if you want to be in the market, when is the better time to buy? Now. Okay, now meaning during the crisis moment. Well, that's true if you're young, right? But as you get older, as you approach retirement, what's the case? Now you're approaching retirement, you only have 5 years, 10 years left. Well, the problem is Now the long-term trend argument may not work for you because you may be caught off guard. This thing can go on for another 5 years, who knows, right? We might be in a long recession. In that case, your portfolio is going to suffer by the time you retire. So then your story is different. Then you should say, well, I don't have that long-term trend. I can't take that extra risk. I should be conservative. I should have, and this is, you should have done this gradually throughout the years, not now, but you should have already been out of the stocks for a significant portion of your retirement account should be out of the stocks as you approach retirement. So the advice that we can give is not about when you should buy, not about what you should sell. It's only about the long-term trends of what finance tells you, what age you're in, and what the future looks like for you. Unfortunately, we don't, like I said, have the crystal ball, and the truth is no one knows. But if you're young, if you're going to, and back to Eric's point, which was a very valid point, unfortunately, the bond market is going to be dead for a while. Because of the Fed intervention, the rates are so low that moving to bonds isn't really an option, which leaves us only with the stock market, unfortunately. So if the bond is almost dead and switching to bonds is not really attractive at all, that means we should be in here for the long run. If you're going to be in the market for the long run, would you rather buy S&P 500 when it's 3,000 or when it's 2,200? Clearly, when the prices are down, it's better to buy at the market at that time. So I want to show you one graph that tells a good, explains well what I want to say here. As you can see here, a 50% drop in the value of your asset, and assume that you sold it at that moment, you panicked. Your stock was worth $1,000, it went down 50% to $500 and you sold it. Well, someone else bought it, right? What does selling mean? Someone else bought it from you. That person, if that person waits until the market comes back to where it was by buying it by $500 from you and receives the $1,000 that it was worth when you had it, when you had bought it, that person is making 100% return. So you lost 50% return. The person who walked in and replaced you, when things come back to where it was before, maybe 3 years later, maybe 5 years later, maybe 8 years later, doesn't matter, but that person is making 100% return. So that's the strength of buying something cheap, right? Rather than buying something expensive. So it's definitely not the time to sell. I'm not saying you should buy, but I'm saying according to, the true return is generated whenever you buy something cheap, okay? So that's something to think about when you want to make your financial decisions moving forward. So going back to Jagdish's questions. So the first question was, some of our alumni may have already lost their jobs. Some of them may have closed down their business. They may need more money to survive. As this situation gets better, what should they do? So the first thing is, at this moment, borrowing money isn't easy. Everyone is looking for money, right? So rather than trying to borrow extra money, I think the first thing you might want to do is try to preserve capital. Try to hold on to the money that you already have. Even if your income has been cut in half, if there's still income coming in, first stop some of the payments. What is the biggest payment that we're making in California? It's rent and mortgage payments, right? So at that moment, what comes to rescue is the CARES Act. As you know, the federal government has just issued this act that lets us defer mortgage payments for 90 days, up to 180 days, if this loan is federally backed. So in order to get this advantage, you should talk to your mortgage lender and see if you can stop your payments so that whatever you would normally be paying towards mortgage can be kept for the days ahead of you where you might run into financial distress. So what I'm saying is be proactive, hold on to your cash now rather than spend it out and worry about it down the road. So since the government already gave you this right, hold on to the money that you have now. The same thing is true for renters. If you don't have a house, if you're renting, you can stop payments for 90 days. The California courts have given you this right. Go and research this topic, try to delay those payments, and hold on to the rent that you would have otherwise have paid. Same thing is true for student loans. The government is giving forbearance, meaning you can, again, delay these payments for a period of time. If you're a student or if you have student debt outstanding, you may think about holding on to these payments. So by doing these, by preserving capital, you will decrease your chances of tapping into your retirement savings. Why? Because just like I said, I don't think you should be getting out of your investments now. Tapping into your retirement savings means you're going to sell them and take it out as cash. Well, doing it at the bottom of the market downturn is not a really appealing idea. Why? Because of the things that I've said. From the bottom, there's a chance that things might go back up really quick. It may go down. I'm not saying it will go up. It may go down from here significantly, but what I'm saying is this is not the time really to be out of the market because you may miss the run in such a case. So, but if you have no other choice and if you want to take money out, the CARES Act again made that easier for investors. Right now, we can withdraw up to $100,000 from these employee-sponsored retirement accounts. Because of the CARES Act, normally you would be paying a 10% penalty. That's waived. These are pre-tax accounts. So whenever you take money out, you're expected to pay taxes out of it. They let you to pay these taxes in 3 years from 2020 to 2022. So that gives you the option to pay these incrementally rather than all at once, the taxes that you owe. And the nice thing is, if you pay back this money within that 3-year period, you get those taxes that you had paid back. So that's quite an advantage. So that's if you withdraw this money. What's the downside of withdrawing? Like I said, you're selling your assets. You're putting it to use somewhere else, but if it would have stayed there in bonds or in stocks, it would have earned you interest. That's what you're losing by taking it out. But of course, if you're in hardship and if you're another choice, this is a good option to do so. The other option is to take a loan from the same account. So from your pre-tax savings account for retirement, you can take a loan. But the difference there is you're expected to repay this loan back in within 5 years. The nice thing is you're paying yourself interest. So they're charging you interest. So on the amount that you've taken out, you're paying interest, but you're actually paying it to yourself. So that's a good thing because you're kind of making for the loss of, remember, when you take the money out, you're losing that return on investment. By paying yourself interest, you're making up a little bit of that. And as long as you pay it within the 5-year period, no problem. You're not paying the 10% early tax penalty, early withdrawal penalty, and the taxes that you owe on this account. There's one downside to taking out a loan. If you lose your job, you're expected to pay all of the loan amount by October of the year that you've taken the money back, which is a problem because if you can't make it pay that money back, they're charging you that 10% penalty, plus they expect you to pay the taxes. So assuming that you're not going to lose your job, if you have a pretty secure job, taking out a loan is the better option. But if you think that there's a good chance that you might lose your job, doing a withdrawal might be the better option. The other question was, should they take home equity loan or line of credit? We know that the interest rates are low. The mortgage rates have come down. If you're not in financial hardship, taking money out for a home equity loan might be a good idea because it's at a cheaper rate at the moment. The problem is the market right now is very stringent on new loans. They want to see a lot of evidence that shows that your credit score is perfect and that you're going to keep your job. So taking that loan may not be easy, even though the rates are low at this market. Taking that loan, especially if you're in financial hardship, may not be available to you. So it's a good option, but if you're already in financial hardship, I don't think you'll be able to tap this opportunity. Should they take a personal loan, given the interest rates seem to be low? Out of all the options that we talked about, a personal loan would be my last choice. These are loans where usually the interest rates are relatively high. The reason why the rates are high is because there's no collateral usually with these loans. So for example, in the retirement account case, your savings are there to protect the loan, right? But in this case, and when you take a mortgage equity loan, your home is there to protect in case you default. The lender has something to claim. But in these cases, usually there's nothing to, you're not putting up anything for claim, so the rates are naturally higher. But there's an exception to that. If you have a certificate of deposit, for example, invested, if you're invested in that already, you can tell your bank, hey, I'm going to put this certificate of deposit as a collateral. Can you lend me a loan in exchange? And when you do that, you get a better term. And in this case, you'd be actually paying a lower interest, and since if you don't default, the certificate of deposit is going to keep paying you interest. So you're going to be recouping some of the otherwise the loss that you would have incurred if you didn't have this asset in place. So that might be an alternative, putting up something as collateral if you have to take this kind of a loan. So that's something to think about and to talk with your financial institution. And that's all the questions that I have.
Thank you, Dr. Gupta. Unfortunately, we don't have time to answer your specific questions. I want to thank you all for attending this webinar.